In today's video, you'll learn about measuring your trading performance. Professional traders record their results each day so that they can track their daily, weekly, and monthly performance. Several years ago, I developed my own measuring tool to evaluate how well I was trading specific opportunities on any given day. We will take a look at two recent trading examples to illustrate this tool. Also, I'll walk you through some of the more common stats that traders will use to evaluate their performance. So stick around and you will learn one of the most effective ways to become a profitable trader. My name is Steve Spencer and I've been a short-term equities trader for over 20 years. I'm also a partner at a proprietary trading firm in New York City where we teach developing traders how to trade stocks, options, and futures. We have actually taken 2 hours of that training and made a free workshop available to all of you. You can access that workshop by clicking on the link that should be appearing right now at the top right corner of your screen, or the one under the video right now. The link will open up the free registration page in a new window, so you don't have to worry about missing any of the video. You'll learn more in this one webinar than from watching hundreds of hours of online videos. So go ahead and click on it now before you forget. Why do we measure our performance? We can understand when it makes sense to scale our trading. One of the more important things that we do on our prop desk here in New York City is scale our traders up from a beginning size when they're starting to a few hundred shares to eventually trading tens of thousands of shares on their positions. And by measuring stats, one of the most important things that we can do, and this applies to you as a retail or independent trader as well, is understand when it makes to scale our trading. And if you're like many of the young traders on our desk, you want to scale up very quickly at the beginning of your career, and it doesn't make a heck of a lot of sense. And when you're looking at statistics and you're talking to a young trader, whether you're the mentor or the coach or a partner at the firm, and you can show them very clearly through the statistics that it doesn't make sense to scale or it does make sense to scale, it's a much more efficient way to do it, a way as an independent trader to avoid blowing up your account. One of the most common things we hear from independent traders is, I got bigger and then I blew up my account. Well, there's very clear statistical ways to measure when it makes sense to increase your size, and we'll work with the mentors, the trading coaches that are working with the developing traders on our desk, are making sure that they're using statistics and scaling in a responsible way. Number two, we can determine where we are the strongest and where we're the weakest. And so, this applies on a trade level as well as other types of statistics such as time of day. Not every time of day trades the same. A lot more institutional order flow comes in the open and the close. Some traders trade the open and the close better. Actually, some traders may trade when things are a little bit slower better. By us gathering those statistics, we can clearly demonstrate to the trader what are the times of days that makes most sense to trade more actively and with more size. Another reason why we measure our stats is we can understand how well we're taking advantage of the best opportunities. I alluded to that earlier in the video as well, that I came up with a proprietary measure that I use a benchmark where I can measure how well I'm taking advantage of the best opportunities each day, and we'll take a look at that as well. And then finally, gathering data is a part of a comprehensive review process. Traders grow and get better by reviewing their work each day, by journaling, by gathering statistics, by working with a trading coach. That's how you get better. That's how you grow as a trader. Uploading those statistics and putting them into a program and crunching those numbers is just part of a comprehensive review process overall. So let's take a look at some of the typical statistical measurements that we use with traders on our desk. The first one is win percentage. I'm sure most of you are familiar with this. It's very simple. It's basically taking the number of trades you're doing and how many are winning trades versus how many are losing trades. So over the course of the month, as a trader, you might make 100 trades. If 60 of them were winners, you made money, and 40 of them were losers, your win percentage is 60%. It's that simple. The second statistic that we track is average size of winners versus average size of losers. From a short-term trading perspective and intraday perspective, we want to really see traders have their average winners be about twice the size or more of their average losers. And when we start to see that type of thing, we can look at scaling traders. That's one of the measures that we'll look at for consistency and the ability to scale traders. The size of winning days to losing days, this is something that you see early on where traders, as they're developing, their winning days and losing days may be comparable, or their losing days may actually be bigger than their winning days. But eventually, you'll see those equalize, and as the trader becomes more successful, the size of the winning days will become larger than their losing days. And by the way, these are rules of thumb. Depending on the trading style of the individual trader, these numbers might get tweaked a little bit, but understand the general direction is the information that I'm giving you. An interesting stat that we keep track of with our software is the holding period. From an intraday perspective, there's 3 different time frames, even in intraday, that you could be trading. You could be a hyper scalper trading second to second, minute to minute. You could be a trader who's trading in-play things and trading move to move, which may be a holding time of maybe 15 to 30 minutes. Or you could be trading an intraday trend, a higher time frame intraday trend, a 30-minute trend, where you're trying to capture a trend for an entire day. You might have a multi-hour hold period. So we capture those statistics, and it's really an interesting thing, especially when a trader's first developing at the beginning of their career. We may spot that they're better as a scalper, as a hyper scalper, because they're very low hold periods, they make more money. We may find that a scalping time frame is not good for a trader. Maybe it just doesn't fit their cognitive abilities, maybe it doesn't fit their comfort level, and we may notice very early on that there's a trend there on longer holding periods, and so we can steer them towards intraday trend trading, or at a minimum, move to move, 15, 30 minutes hold periods. Time of day is intraday. There's different institutional order flow, and stocks trade differently because of that during different times of day. We know that things will make very strong drives right in the opening minutes, in the first 15 or 20 minutes. We know that in the middle of the day, things tend to slow down, and it becomes a little bit more noisy. And then at the end of the day, as we move towards 2:30, 3 o'clock, volume comes in again, institutions are more heavily trading, and the way that stocks trade will change then as well. And so by tracking the time of day for our traders, we can see, do they have more of an edge right on the open? Do they tend to trade better in the final hour, where more institutional order flow has come in and they've gathered data during the day watching stocks trade very closely? That could be part of another reason why they're trading really well in that final hour. And then some traders will struggle quite a lot between 11 a.m. and 1 p.m. because of the slowness. Algos tend to dominate the trading action a little bit more, and vice versa. Some traders gather information on the open. Once they see what the strongest and weakest stocks are, they'll put on positions as it gets a little bit later in the morning and try to capture those moves throughout the rest of the day. And so it's important really to see, what's going on. Is there a significant difference in performance based on the time of day? And the final statistic is the daily equity curve. And all this really is a visual, kind of similar to a stock chart, where you punch it up and you look at it and you want it to be trending. If it's strong, if the equity curve is strong, like a strong stock, will be trending up from the left, up and to the right. And when that's a smoother equity curve and it's trending up, it's certainly the trading coaches that are working with the trader are going to encourage them to increase their size and scale up and take on more risk. And so those are typically, some of the bigger ones, some of the bigger stats that we keep. And if we actually take a look, I grabbed a little bit of statistics, one of the junior traders on the desk, and kind of take a look at some of the things here. Some of the things we talked about are in here, the win percentage, the average winners versus the average losers. It puts it in a very nice organized fashion for them, so they can quickly look at it, and then they can crunch this. I did this over like a 28-day period, but you can do it weekly as part of your weekly reviews as well, that you're sharing with your mentor or your trading coach, and as for yourself as well. And so this is kind of the program that we use, what it looks like on kind of the main stats page. And then you can drill down. Here's kind of some visuals on some of the things we talked about. Time of day. You can see it sticks out like a sore thumb, that 11 a.m. to 12 p.m. hour. This particular trader was just losing money at that time. And we see that's a pretty common thing from 11 a.m. to 12 p.m. or 11 to 1, where traders struggle quite a bit. And then on the right here, this is performance by hold. And you can see this trader clearly, as the hold period moved higher, they did a lot better. And I think you could also see that on the prior page we're looking at when they're crunched their numbers, which is the higher holding periods, they're doing better. So this is a trader who's doing better from an intraday swing perspective, maybe even a move to move, like a 30-minute trade to a 60-minute trade. That's what makes sense and where this trader really should be focusing on in terms of where they're putting on risk. So there's a bunch of statistics that we keep track of on our desk. I wanted to now introduce you to the tool that I use, which is really, I think, important to evaluate the best opportunities each day. And so for those of you who are familiar with us, you know that on our desk, one of our areas of focus from our videos is stocks in play. We are trying to find stocks with strong news catalysts, where the bigger institutions are going to be piling in or piling out based on the strength of that quality of that catalyst, the strength of that news. And that is really where my focus is, and why many years ago, it's been a while since I developed this particular measure. I developed this measurement, and what it does is it basically gives me a way to evaluate my own performance on a best opportunity on any given day. And we're going to take a look at two recent examples of trades and kind of see how this works. But here's the measurement tool. Basically what I'm doing is I'm taking 1/2 of the max position size I had on a particular day, and I'm multiplying it times the size of the intraday move that the stock has made. That is going to be my performance benchmark, and I'll give you an example. Here's a hypothetical before we get into the real examples. So the hypothetical is, let's say you were looking at a short setup in Tesla, TSLA below $300, which is a very significant price for the stock. And let's say that the trade triggers, it's holding below $300, and I'm initiating a short position, and my downside target, my best case for that day is it goes down to 280. And let's say on this particular position, the largest position I had was 2,000 shares, and the stock actually did trade down to 280. So what I'm going to do is multiply 2,000 shares times $20. I'm going to divide it by 2, and that's going to give me a benchmark of $20,000 for the day. If the total P&L for the day was 30,000, more than 50% above the benchmark, that's going to be an A. If you came in at the benchmark, it's going to be a B. And then obviously as we work our way below the benchmark, it's going to be C, D, and F. And so this is just a hypothetical. Let's get into some real world trades that happened recently so we can kind of take a look. So the first one is AMD. Those are familiar with the stock. It's a technology chip maker. It's in a strong uptrend. You can kind of see it was in a nice uptrend working its way up from $10 to $15, and that uptrend accelerated recently from $20 and started to get steeper, moving into the 30 area where it consolidated. And so this particular setup that we're looking at was, as the uptrend accelerated and it started to move sideways for a couple of days, there was a breakout trade above $30. And so for myself, the way that I want to look at this is it's a breakout opportunity above $30. If it moves 1 ATR intraday, it's going to move potentially up to $32, $33. And so you can see very clearly on the first day, on the big picture here on the 2-day chart, that it failed at between 30 and a little bit above 30 on day 1. And then on day 2, it moved up and then started to consolidate in that area where initially it was establishing a long position. And so the way I'm going to evaluate myself is, how did I do from the initial entry here all the way up to the close where it finished its move for the day? And I have a chart here where we drill down and I show you, I label points 1 and 2. These are potential action points from an intraday trading perspective. Earlier in the video, I mentioned to you there are 3 styles of trading intraday. There's hyper scalping, there's move-to-move trading, and there's intraday trend trading. These action areas are going to help you from a move-to-move basis lower your risk and potentially actually capture more of the move if you're good about taking off, if you're good at taking off some of your position and building back into a position into a pullback. And so let's take a look at these 2 points. The first point I highlighted for you was after it broke out from above $30 and moved up to the first whole number, that's typically going to be a spot where institutions are going to have some orders to sell, and a move-to-move trader will look into the whole number to potentially take off some risk, 25 to 50% of the position, and then if there's a significant pullback, build back up to a full-size position. Or in this case, if there's a shallow pullback, just use that point 1 as a spot to reestablish any shares that were taken off on the initial up move into 31. And so that was one potential spot to take action. The second spot to take action was actually up at 32, closer to a full ATR move for the stock. and where it actually started to have some trouble. It moved up to 32, had a little bit of trouble there, and then it actually did have a decent pullback. This is a spot where you could take off 50% of your position, and unless it had a significant pullback of 30-40% of an ATR, not rebuild, and you might actually have a lighter position into the close in this case. But regardless, at the end of the day, what you're going to do is you're going to take that full-size position, divide it in half, and multiply the distance from where you established the initial position, which was 30.25, and I think the move finished up at around 32.5, so 2.25. So half your max position size times 2.25 move, that's going to give you your benchmark of P&L and how you're going to evaluate how you traded it. I want to give you one more example. Recent stock, here's the daily, had earnings. Last quarter, you can see it had gapped up above $100 a share, moved sideways for a couple of months, and then the last couple of weeks into earnings had moved higher in anticipation of good earnings. And in fact, they reported good earnings. It was on our radar potentially for a short because the guidance wasn't that good, even though the earnings were good, and it had already run up about 20% this year, more than the market. And so here is kind of what it looked like on the open. Here are the highlighted for you support 1 and support 2 on the morning game plan notes that I showed you on the daily chart. And when something gaps up like this and we're thinking about it potentially selling off because the guidance wasn't as strong as the actual earnings, what we want is price confirmation right on the open. And so you can see I highlighted a circle there for you, and I showed you it can either break to the upside or break to the downside. In this case, right on the open, after a quick little pop, it actually broke to the downside, and we had our confirmation that it potentially would be a good downtrending stock for the day. I then drilled down for you into the action points, the same thing that we did with AMD, and the initial entry where you could have gotten in based on weakness right on the open is when it started to hold below 122, and then what we wanted to see once you got in on the short side was it move below support 1 at 120. This is really your first action point. So if you shorted on the open, if your entry was 122 and it flushed down into the 120 area, which was S1 on our sheet, if it started to hold there, this is a spot for potentially to take some risk off before you see a consolidation below that support. And the next action point was actually on the sheet 118, and this was really the one where you could have turned this into a very big trade, because after the second down leg, it came down to about 116 or so, and it spiked up to 118 a couple of times and failed there. And so a general rule of thumb is if a stock is moving lower and you have support 1 and support 2 on your morning game plan sheet and it moves below those and then it retraces the first time, you can see on the left, kind of the left there, I highlighted for you, it moved up and it fails. And then it comes back up there and fails again. This is a very good spot to be aggressively short. You know your risk. You know your risk is going to be above 118.5. You're going to have a stop. You know that when it trended down right on the open, that when it popped up there, it failed. And you're going to establish into 118. As it moves lower and comes into the morning low, that's a spot also where you can actually take off some risk. And when it pops back up to support 2 again, you can reestablish. And then eventually see if it has another leg down. But the point is, when you get into these stocks and you have short-term trading skills, you're not going to do entry 1 on the left there and hope that it just trends down the rest of the day straight from 122 to 115. You're going to, as it comes off the full ATR or 2 ATRs, you're going to scale out, and when it pops back into the natural place where it potentially could fail, that 118, you're going to reestablish. Or if you actually miss the initial trade and it pops back into that 118, that's going to be where you put on your trade with tight risk and see if you can capture a larger leg to the downside. And then at the end of the move, if let's say in this particular position you had 1,000 shares and that was your max position size, and the initial entry was from 120, let's say, and it went down to 116, that's 4 points, 1,000 shares, divide that in half, $2,000 would be your benchmark. And so if you made $3,000 trading this on the short side, you're going to give yourself a good trade. If you only made $1,000 and you were short 1,000 from the 220, from the 120 down to the 116, you're going to give yourself probably a C minus. I find it to be a very effective tool. sort of evaluating the best opportunities each day. So just to recap for you, we're measuring our performance because it's essential to our growth as traders. It allows us to scale. It allows us to understand our areas where we're strong or where we're weak. In the areas where we're strong, we're going to focus on those. Those are going to be trades that we hone in on each trading day, the trades that we get a lot bigger in. It's also going to tell us how well we're trading potentially. And if we have a baseline, let's say we've been trading for a while and we know that typically our winners are 45 to 55%. And we look back and we do our weekly review and our winning percentage is 35%. That's going to tell us one of two things. One, it's going to tell us that we're not seeing the market well, or two, that the particular trade setups that we're going to are not working well in the market. Either piece of information is very valuable. We're either going to adjust what we're doing in terms of how we're trading, or we're going to scale back until we're trading better, whether it's the market or our own personal trading, which is causing that. So what you're going to want to do is each day upload your data, whether it's into an Excel sheet or a trading program like we use, and it's going to allow you to evaluate your trading and hopefully become more consistent. And once we become more consistent, we're going to scale up our trading to become a much bigger trader.